Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's what has our attention heading into the second quarter of 2024. First, the forward price-to-earnings ratio of the S&P 500 is nearly as high today as it was at the market top at the end of 2021. Back then, the forward PE ratio was 21.6 times. Today, it's around 21 times. The high valuation is not because earnings are at a trough and therefore big growth is expected. It's just exuberance on the part of investors about tech innovation as well as easing monetary policy by central banks. When we look at valuation by sector, it's still most of the cyclical sectors that appear to be the most overpriced. Defensive sectors like consumer staples, healthcare, and utilities are trading close to their historic average valuation. But cyclical sectors like consumer discretionary, financials, industrials, technology, and materials are all trading about 20 to 25% above their historic norm. Valuation is not a good predictor of expected returns for the next year, but for a firm with a 5-year investment horizon like Oxbow, a high starting valuation makes it difficult to find opportunities that we believe will produce double-digit annual returns. We talked previously about high fiscal spending by the U.S. government surprising us in 2023. There's another group that's been spending more than anticipated over the past 2 years that's helped the U.S. economy outgrow the rest of the world. That's the U.S. consumer. From 2009 to 2019, the average personal savings rate of U.S. consumers was about 6% of their disposable income. After the stimulus checks from the U.S. government subsided and disposable income returned to normal, the U.S. consumer's savings rate has only averaged 4%. That 2% boost in spending has been meaningful to sustaining economic growth. We're mindful of any new areas that could slow consumer spending. Higher gas prices are one area that could be a concern heading into the summer. The price of gasoline tends to rise during the summer when more miles are being driven. Based on projections by AAA, we're heading to a higher gas price than was experienced at any point last year. This is worth tracking since a high gas price, shown in yellow on this chart, tends to have a negative impact on consumer sentiment, which is shown on the chart as the red line. Another area we're tracking is the sudden rise in non-mortgage interest expense being paid by U.S. households. Mortgage payments have not been a headwind for most homeowners that locked in a low rate over the past 15 years. But interest rates on credit card balances, auto loans, and small business loans have skyrocketed over the past 2 years. It's caused non-mortgage interest payments to more than double over the past few years. It was just a few years ago that the Federal Reserve complained about not being able to get inflation above its 2% target. How times have changed. If we look at inflation in the United States over the last 1, 2, 3, 4, 5, 7, or 10 years, the average annual inflation is 2.8% or higher for every time horizon. Since we think inflation is not dissipating, it surprises us that central banks around the world appear to be unified in their intention to cut rates this year. This could keep the good times going in the near term for the global stock market, but would also likely push inflation higher and lead to bigger trouble down the road. Higher stimulus from central banks is one reason that adding energy stocks was the biggest move we made in the stock portfolios in the first quarter. Another reason is the structural need for cheap energy is not going away. Developed markets like the United States, Europe, and Japan are focused on becoming more energy efficient. If you live in one of these markets, it's easy to think the need for fossil fuels is going to disappear relatively soon. In fact, the growth in energy demand is coming from emerging markets. These countries need greater access to low-cost and reliable sources of energy for their citizens. That's why we expect the demand for oil and gas to remain steady. We're finishing this video by taking a step back to see the long-term view at investing in stocks. If you must narrow the driver of stock performance to a single variable, stocks move with the generation of earnings or cash flow. This is why we primarily invest in companies that can consistently grow revenue at least as fast as nominal GDP growth, say at least 4% a year, that have a competitive advantage that allows them to maintain their profit margins, and that don't carry too much debt, which could impact their interest expense. Once we know the growing companies we want to potentially own, it's just a matter of discipline to not overpay for that growth. We are sometimes asked about international stocks. There are plenty of great companies based overseas, but broadly, this lack of growth has been a headwind for those markets for nearly 2 decades. For both Europe and emerging markets, the price of the indices hasn't appreciated in 17 years. It's important to actively evaluate the companies in your portfolio because most businesses are going to reach a stall point and stop growing. And when that day comes, you do not want to own those stocks any longer. Over the past 70 years, 3/4 of large companies saw their growth eventually stall and the business fade in relevance. We are hesitant to invest in any business generating 0 to 2% revenue growth because it doesn't take much to turn that growth negative. And once growth goes negative, it's very difficult to turn things around. Just look at all of the declining retail chains at the mall over the past 9 years as an example. In conclusion, better than expected spending by the US government and consumers has been a positive surprise that's benefited stock investors. The catch is the stock market is now valued at a price today that we think overvalues the growth potential. We are still finding opportunities such as the energy stocks we purchased in the first quarter, but we're not willing to overpay for that expected growth. Markets move in cycles, and there will be great opportunities again in these cyclical sectors that are still a bit overvalued. If you have any questions about this or would like to learn more about Oxbow, please contact us. We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.